Welcome options traders, hello everyone, and I wanted to post a video here, kind of an unplanned follow-up to one that I posted earlier in the week that said, don't fear intrinsic value. So if you haven't seen that video, you'll probably want to go back and check that out. But in that video, I made the comment that we don't count cash as part of the option. And I've actually made that point in a lot of previous videos, and I know all of you who are training with me have heard me say that countless times when we're talking about option strategies. The only thing that makes the option strategy work is the extrinsic value. And so that's why we have to understand that portion of the options premium. So I received an email from a trader who said, hey, why doesn't cash count? We're paying for it. Why do you keep saying that we don't count the cash as part of the option? And it's a very good question because in order to understand option strategies, you have to understand how options are priced. So let's take a look at a very important question here. Why doesn't cash count as part of an option? Let's start off with a simple example. Let's say that our stock is trading for 100 and maybe you've got shares in your account and I come up to you and say, I'd like to make an agreement with you. I would like to buy those shares from you today, but I'd like to give you $20 down today, and then I will give you a guaranteed payment of $80, the balance, in 30 days. Now it's guaranteed. Let's say maybe it's sitting in an escrow account somewhere, so no matter what happens to the stock's price, you're guaranteed to get your remaining $80. Stock's trading at zero, fine. You're still getting your $80. What type of an arrangement is this? Is there an option in there anywhere? No. Take a look. If I give you $20 down and I give you $80 in the future, add those two together, it equals the $100 stock price. So I'm still paying the full $100 for the stock's price. I don't have a right, I don't have the right to walk away, the right to exercise. There are no rights. It's just a structured payment here for a guaranteed transaction in the future. So what we're looking at here is really $20 down today is a down payment. And really the only benefit that I'm receiving here is I'm getting an interest-free loan on the $80 for 1 month. Right? Because if I gave you the full 100 today, you would have an additional $80 that you could invest for that 1 month, let's say in a bank. Not going to earn much by today's standards, but the fact is that's about the only thing that's missing from the equation. Now that's an important point because we're going to find out when we go to an option pricing model, and you're going to see why the interest rate affects the call options price. But for right now, just understand that's really the only benefit that I would get in this. I'm still paying you the $100. I'm just getting a little bit of an interest-free loan on that balance. But now let's change the deal a little bit. Let's remove the word guaranteed and let's make it more like an option. Let's give me the right to pay $80 in 30 days. Different deal now. Now you're not guaranteed to get your $80. Why? Let's say that the stock falls, maybe $40 and is trading at 60. Well, I'd rather just walk away from the deal. I don't want to pay $100 for the stock that's now worth 60. I'll just walk away from the option. I have a real benefit here. There's a risk to you in that stock might fall and I might decide to not give you the $80. That's a very different deal. And because I have the right, you might say, you know what? There's a risk to me here. So just to make it worth my while, if you pay me an additional $5, I'll do it. That additional $5 is what I am paying for the option. It is not the $20 today. It is not the $80 in the future or the potential $80 in the future. It's the additional $5 that is really an insurance policy for you. Now take a look at what we've done here. Couldn't I also restructure this terminology here to say, what if we had an $80 call trading for $25? Isn't there $20 of intrinsic value there with the stock at 100? Yes, that's just the cash. You can exercise the call, sell the stock for 100 and pull the $20 out. There's nothing magical about that. That's got nothing to do with the option. But there's $5 of extrinsic value or time value. And that is what you're paying for the right to walk away. So in this example, even though you're seeing the $80 call trading for $25, you shouldn't see it as a $25 option. It's $20 down payment, right to pay $80 in the future, and because the seller of that option is not guaranteed to get the $80, there's an extra $5 in the package. That extrinsic value is what you're paying for the option. Now, sometimes that's still confusing, so to make the point clearer, this is a little demonstration I do in a lot of my classes, and I think it really drives home the point. Let's say that you're walking through maybe an antique store here, and this is our antique vase. And you're asking the shop owner, how much is this vase? And the store owner says it's $105. Well, simple question, how much did you pay for the vase if you buy it? Well, $105. That's all you got was the vase. You paid $105. That was your purchase price. But now let's change the deal. Let's say you look inside the vase and you see that there is $100 cash. And that comes with the vase. The price tag is still $105, but somebody asks you now, how much did you pay for the vase? You should not say it's $105. Your answer would be, well, I only paid $5 for the vase. And yet your friend might say, hey, wait a minute, the receipt says you paid $105. How come you're saying you only paid $5 for the vase? And your response would be, well, there was $100 of cash in the deal. I mean, that just came right back to me. Yes, I paid $100, but I got $100 back. So that's kind of a wash. What did I pay over and above cash? $5. That's the extrinsic value. And that's really where the term comes from. It exists outside of cash. So in this example, what is the thing here that you're paying for over and above cash? It's the vase. That's what's $5. That's the extrinsic value because it's over and above cash. So to drive home the point, if you bought this vase for $105 and there was a $100 bill in there, you should understand that you only paid $5 for the vase. In other words, you're not counting the cash. All right, now let's see how that applies to a real stock. And we're going to look at Home Depot here. And the reason I chose it, I just happened to shoot the screenshot when it was trading for exactly 202. So it makes for some nice round numbers on intrinsic value. But let's take a look at a deep in the money option. Let's say this strike right here at the top, the 185 call with 22 days to expiration. Now again, a lot of new traders would look at the mark. Remember, the mark right here is the midpoint between the bid and the ask, and that's most of the time where you could get that order filled. So they would look at this and say, well, it's about a $17.70 option. No, it's not. Yes, that's true what you have to pay in total, but $17 is intrinsic value. That's cash. How do I know that's cash? Well, if I had the 185 call, I could exercise it, pay the 185, immediately sell the stock for 202, and presto, I've got $17 cash. It's no different than if you reached inside the vase and pulled $17 out. Anybody can do that with the 185 call right now. That's just cash. However, if you add those two figures together, the 17 and the 185, what do you come up with? You don't come up with 202. You come up with 202.70. Where's the extra 70 cents coming from? That's the extrinsic value. That's the option right there, extrinsic value. There's the 70 cents. That is what exists outside of cash. This is what you're paying for the option. So, recap. If you buy this option, how much is it going to decay in the next 22 days? 70 cents. Could it lose more than 70 cents? Yes, but that would require for the stock price to go down. And you would be losing dollar for dollar just as if you were the stock owner. There's no difference in the option and the stock. So it's completely unfair at that point to say that the option is different or is riskier from the stock. So if the stock falls 10, stock trader would lose 10. Option trader would lose $10 of intrinsic value. The option trader would also lose this extra 70 cents. The options trader is really worse off by 70 cents. So why do we do it? Because we have the right to walk away. If the stock should ever fall below 185, we can choose to walk away from the deal. There's a benefit for us. And that's what we're paying for in this 70 cents right here. Now, a little interesting side note here about options pricing. We're getting a skew right here, but let me see if I can find one that's working out well. This is pretty close right here, this 191 strike. Notice that we're paying 92.5 cents, about 93 cents for the option, because that's the extrinsic value. Theoretically, I could recreate a call option by purchasing the stock and purchasing a put. That's what we call a synthetic call. And if you don't understand the synthetics, there's a video in here on that as well. But that means that theoretically, the put should also be trading for about 98 cents. And look right over here. Just about the same. Interesting. Stock plus put is exactly the same as a call. So over here on the right, if you're spending $1 for the put, how much are you really spending for the insurance on the call? About $1. Right there. you're not spending $11.47. $10.50 of that is cash. Only thing you're buying here in the option is the 98 cents. So now in this case, up here, back up here at the top, we have 70 cents of extrinsic value here on the call and only 39 cents on the put. It's what we actually call a put-call skew. There's all kinds of skews, tilts, put-call skews, positive, negative skews, but these are opportunities as well for people who know where to look. And there's definitely a skew going on here. Part of it, though, is the cost of carry, but because there's only 22 days, that's not going to amount to much. And we'll see that come to life here when we look at the pricing model. But the main thing I want you to see right now is that the intrinsic value represents the immediate cash you could grab by exercising that call. It has nothing to do with the option. All right, let's go back to the CBOE pricing model here. And again, easiest way to find this is go to Google, just type in CBOE option pricing calculator, and it should bring you right here. But what we're looking at are theoretical prices of calls and puts based on these assumptions over here on the left. So I've got a $100 stock, $100 strike, about a year to expiration, volatility 20%, interest rates 5%, and it says that the theoretical value, the fair value of that call is 1033, and the put's about 608. Now, it might appear on the surface, because these are at-the-money options, right? The stock and the strike are at the same price, that this is all extrinsic value, which is true, but doesn't necessarily mean we're paying $10 for the option, even in this case. Why? Remember back to the video, there is a cost of carry. The put is trading for 608, and earlier I said we could look at the put as the price of the insurance for the call. So why are we paying 1033 instead of 608? Because there's a cost of carry. Watch what happens if I make this 0. Now you're going to see that the call and put are priced the same. That is definitely what you're paying for the option if there's 0 interest rates. But how much are we paying for the interest rate? Well, that's simply the cost of carry. So watch this. I'm going to make the volatility real close to 0. I don't think this model will let me go down to anything less than 0.1. So let's just say we've got a year to go. There's virtually no volatility. The call option's worthless. It's trading for about 4 cents for a 1-year option. But what if I made interest rates 5%? Think about it. I am borrowing $100 because I'm not going to be exercising that for a year, if I exercise at all. And that means I have a benefit. I'm getting an interest-free loan. And there's actually what's called an arbitrage deal where free money could be made if this interest rate is not reflected. So watch what happens if I make this 5%. Now it tells me that that call value is $4.76. Where's that coming from? Well, how much interest would you owe in 1 year on a $100 stock if interest rates are 5%? You'd owe $5 worth of interest. That's what we would call the future value. But if I want to know today's value, I take the $5 interest divided by 1.05, and guess what I come up with? 476. So even in this case, if I saw this trading for 476, I wouldn't even say that's the price of the option. That's just the cost of carry on the exercise price. And that's important to understand when you start looking at expensive stocks and long-dated stocks. Sometimes traders go, this is really expensive, and sometimes it's just the cost of carry. It's got nothing to do with volatility. You need to know that. So once again, I could see that I'm paying virtually 0 for the option. That's the value of the put. Now let's bring the volatility back up to some more normal level here, 20%, but let's put our strike at 80. This is what we looked at in the presentation. Now look what it's telling you. The option is $24.48, and people gasp and go, oh, I would never spend that much on an option. Well, let's take a breather here for just a moment. How much are you spending on the option? Now you should know, look at the put. You're spending about 71 cents on the option. Why is it trading for 24? Well, let's break it down. First of all, there's $20 of cash in the deal because I have the right to pay 80 for stock currently worth 100. If I have the 80 call, I could instantly exercise it, sell the stock for 100, and pocket $20 cash. It's got nothing to do with the option. Where's the other $4 and change coming from? That's from the cost of carry, remember? Watch what happens if I made the interest rate 0. Now the option here is trading for $21.15, of which we know $20 is cash. There's no cost of carry, so it looks to me like I'm paying about $1.16 for the option, exactly the price of the put. So when you realize that when you go deep in the money like this, you're really trading cheap shares of stock. And that's why I'm seeing this delta starting to approach 90 and my gamma go to 0. But in this case, I'm only spending $21 instead of the $100 for the stock, getting almost 5-to-1 leverage. But the beautiful thing about options and strategies is that once you understand how they're priced, I can change this. If I still think that that's too much, maybe I come down to the 70 strike and I can only pay 23 cents for the option. Yes, I got to kick out $30 total, but $30 of that is cash. Only 23 cents is what I'm paying for the option. I'm getting better than 3-to-1 leverage, 97 delta, no gamma. That's stock, people. That's not even an option anymore. There's 23 cents in that option. It's virtually worthless. So the point is again that many times new traders look at this and they think that that's an expensive option and then it's going to decay $30.24 over the next year. It's not. 24 cents is what you're paying for the option. So I hope that helps to answer the question why we don't count the cash. Why? It has nothing to do with the option. So remember, to understand option strategies, you must understand how options are priced. And for those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, if you're looking for some free information on options trading, please join us on the Facebook trading group Options A to Z.